Imagine walking into a car dealership with $0 in your pocket. No savings, no down payment, maybe even a weak credit score. And still, the salesman smiles and says, "Congratulations. You're approved. It sounds like a blessing. A new car. No money down. Low monthly payments. Drive today. Pay later." But what many people do not realize is this: that $0 down car deal can quickly become one of the most expensive financial mistakes of their life. Because behind the shiny car, the friendly salesman, and the big sign that says "no money down," there may be hidden fees, high interest, long loan terms, and a debt trap that follows people for years. This is the story of how a $0 down car loan became a $30,000 nightmare. In America, a car is not just a luxury. For many people, it is survival. You need a car to get to work. You need a car to take your kids to school. You need a car to buy groceries. You need a car to go to the doctor. You need a car to live a normal life. So when someone is struggling financially and they see an ad that says, "Drive today with $0 down," it feels like the perfect solution. But the question is, why would a dealership give someone a car with no money down? Are they being generous? Or is there something hidden inside the deal? To understand the trap, we have to start with the person who falls into it. Meet Jason. Jason is 29 years old. He works full-time at a warehouse in Ohio. He makes enough money to survive, but not enough to save much. Every month, his paycheck is already divided before it even arrives. Rent, electric bill, groceries, phone bill, insurance, gas, credit card payments. By the time everything is paid, Jason has almost nothing left. For years, he drove an old used car. It was not pretty, but it worked, until one morning, on his way to work, the engine light started flashing. The car slowed down. The steering got heavy. And within minutes, Jason was stuck on the side of the road. A mechanic later told him the repair would cost more than the car was worth. Jason had a problem. Without a car, he could not get to work. Without work, he could not pay rent. And without rent, his whole life could fall apart. He needed a car, fast. But there was one big issue. Jason had no savings, not $2,000, not $1,000, not even $500. So when he started searching online and saw an advertisement that said, "Bad credit? No problem. $0 down. Drive away today," it felt like hope. Jason walked into the dealership the next day. The parking lot was full of shiny cars, SUVs, sedans, pickup trucks, big price tags, bright balloons, and signs everywhere saying everyone approved, no money down, and low monthly payments. A salesman approached him with a big smile, looking for something reliable. Jason explained his situation. He needed a car. He had no down payment. His credit was not perfect, but he had a job. The salesman nodded like he had heard this story 1,000 times before. Then he said the words Jason wanted to hear. "Don't worry. We can work with you." Within minutes, Jason was test driving a car he never thought he could afford. It had a clean interior, a touchscreen, backup camera, smooth steering, and that new car feeling. Jason was not thinking about interest rates. He was not thinking about loan terms. He was not thinking about the total cost. He was thinking, "I can finally breathe again." And that is exactly when the trap begins. When Jason sat down in the finance office, the conversation did not start with the total price. It started with one question: "What monthly payment are you comfortable with?" Jason said, "Maybe around $450. The finance manager typed some numbers into the computer. Then he said, "We can get you close to that." Jason felt relieved, but this is one of the biggest tricks in car financing. Many buyers focus only on the monthly payment. They ask, "Can I afford this every month?" But they forget to ask, "How much will this car cost me in total?" Because a monthly payment can be lowered by stretching the loan longer. Instead of 36 months, make it 60 months. Instead of 60 months, make it 72 months. Instead of 72 months, make it 84 months. The payment looks smaller, but the total cost becomes much bigger. Jason thought he was getting a manageable payment, But what he was really getting was a long-term debt contract. Here is the part most people do not understand. A down payment protects you. When you put money down, you reduce the amount you borrow. But when you put $0 down, you finance almost everything. The car price, taxes, registration fees, dealer fees, documentation fees, add-ons, warranties, gap insurance, and sometimes even negative equity from an older car. So even if the car is listed at $24,000, the loan can become $28,000 or $30,000 after everything is added. Jason did not notice this. He saw the car price. He saw the monthly payment. He signed the paperwork. But buried inside the deal were thousands of dollars in extra costs. A $0 down deal does not mean the car is cheaper. It means the buyer is borrowing more. And when you borrow more, the bank earns more interest. Jason had another problem. His credit score was not great. He had missed some credit card payments in the past. He had medical bills and collections, and his credit history was thin, so the lender approved him. But at a very high interest rate, this is where the real damage begins. A high interest rate can turn an average car loan into a financial monster. Jason thought he was buying a $24,000 car, but after interest fees and a long loan term, he could end up paying far more than the car was ever worth. And the worst part? In the first few years of many car loans, a large portion of the payment goes toward interest, not the actual car balance. So Jason could make payments for months and still owe almost the same amount. Every month, he felt like he was paying, but the debt was barely moving. Now comes another problem. Cars lose value. The moment a car is driven off the lot, its value starts going down. This is called depreciation. Jason's car may have cost $24,000 at the dealership, but a few months later, it might only be worth $20,000 or less. After 1 or 2 years, it could be worth much less than the loan balance. This creates a dangerous situation called being upside down or underwater on the loan. That means Jason owes more on the car than the car is worth. For example, he owes $27,000, but the car is only worth $19,000. That means if he sells the car, he still owes money. If he trades it in, the debt follows him. If the car gets totaled, insurance may not cover the full loan. This is why $0 down loans are risky, because the buyer starts with no equity. From day one, they may already be behind. Jason also got offered extra products. The finance manager said, "You should protect your investment." Then came the add-ons, extended warranty, paint protection, tire protection, service contract, anti-theft system, gap insurance, maintenance plan. Some of these products can be useful, but in many cases, buyers do not fully understand what they are buying. They just hear, "It only adds a little to your monthly payment." That sentence is powerful, because $25 extra per month does not sound like much. But over 72 months, that is $1,800, add several products, and suddenly the loan is thousands of dollars higher. Jason did not say yes because he was careless. He said yes because he was scared. Scared of repairs. Scared of losing the car. Scared of making the wrong choice. And that fear made the deal even more expensive. For the first few weeks, Jason loved the car. He drove to work comfortably. He did not worry about breaking down. He felt proud, but then the bills started coming. Car payment, $489 insurance, $230 gas, $108 maintenance, $60 registration renewal, unexpected tire repair. The car was not just a monthly payment, it was a monthly lifestyle cost. Before the car, Jason was struggling. After the car, he was drowning. He started using his credit card for groceries. Then, he missed a phone bill. Then he paid rent. Late. Then he started choosing between bills. The car solved one problem, but created 5 more. 6 months later, Jason's hours at work were reduced. His paycheck got smaller, but the car payment stayed the same. He called the lender and asked for help. They said he could defer one payment, but the interest would still continue. So he skipped 1 month, then another emergency happened. His child got sick. His rent increased. His insurance went up. Now he was behind. The lender started calling. At first, polite reminders, then stronger warnings, then late fees, then the threat every car buyer fears, repossession. For Jason, the car was not just a vehicle, it was his way to work. If he lost the car, he could lose his job. If he lost his job, he could lose everything. That is the cruel part of the trap. The thing you need to survive becomes the thing that can destroy you financially. Many people think if the car gets repossessed, the debt disappears, but that is not how it works. If Jason's car is repossessed, the lender takes the car and sells it, but they may sell it for less than what Jason owes. Let's say Jason owes $25,000, the lender sells the car for $17,000. That leaves an $8,000 balance. Jason no longer has the car, but he still owes the debt. This is called a deficiency. Balance. Now he has no car, damaged credit, collection calls, and a remaining debt. The loan did not free him. It trapped him deeper. It is easy to blame the buyer. People say, they should have read the contract. They should not have bought the car. They should have saved money first, but real life is not always that simple. Many Americans live paycheck to paycheck. Many cities do not have reliable public transportation. Many jobs require a car, and when someone is desperate, they do not shop like a rich person. They shop like someone trying to survive. Dealerships know this. Lenders know this. Advertisements are designed to target people who need fast approval. The message is not, let's make the best financial decision. The message is, drive today, worry later. And when later arrives, the buyer is already locked in. So how can someone avoid the $0 down car loan trap? First, do not focus only on the monthly payment. Ask for the total cost of the loan. Second, check the interest rate before signing. A bad interest rate can cost thousands. Third, avoid unnecessary add-ons. Do not accept products just because they make the payment look only slightly higher. Fourth, try to make a down payment, even a small one. It reduces the loan and protects you from being underwater. Fifth, compare financing before visiting the dealership. A bank or credit union may offer better terms. And most importantly, do not let pressure make the decision for you. A car deal that must be signed today is often a deal you should question. Jason's story is not rare. Across America, many people are driving cars they cannot truly afford, not because they are careless, but because the system makes debt look normal. A car is advertised as freedom, but for many buyers, it becomes a chain. The shiny keys feel exciting on day one, but months later, those same keys can represent stress, late payments, credit damage, and fear. The $0 down sign looks like an opportunity, but sometimes it is only the entrance to a much bigger trap, because the real price of a car is not just what is written on the window sticker. It is the interest, the fees, the insurance, the depreciation, the risk, and the years of payments that follow. So before you sign a $0 car loan, ask yourself one question: am I buying freedom, or am I buying a financial trap? Because sometimes the most dangerous deals are the ones that look the easiest. This is Unfold Stories. Real stories, told raw and real.